and welcome to this week's Market Outlook webinar with me, David Jones, and AUDUSD Markets. If you're watching the recorded version of this, it was held live on Wednesday, the 26th of July at 12:30 in the afternoon. So this is a webinar we do every week, Wednesday lunchtime, and it's a couple of aspects to it. Every week we take a little look at a strategy approach. This week we'll talk about trends, trading with the trend, and maybe not a different twist on it because the trend is the trend, but maybe some ways that you can force yourself to sit on your hands and not trade against major trends. Just maybe a couple of tips for that, and also we'll look at opportunities in markets maybe over the days and the weeks to come. I think that risk warning has been up for long enough, so we will flip over to the trading platform. So as usual, we're using AUDUSD's platform, Trade Hub. AUDUSD are probably better known for copy trading, follow trading, all that sort of stuff. But also you can do, if you have an account, you can do self-directed trading as well. And this is via Trade Hub. So this is what we're looking at now. I thought we'd start off because we've had some major UK economic news this morning. So we've had the latest GDP figures. So UK economy grew by 0.3% in the last quarter. And you can see the move there. Let's just, if I zoom in on that. So the figures came out 9:30, wasn't it? So you can see this is pound against the dollar that we're looking at here. So it was trading. Actually, it had a bit of a move. Then it's built in it. So there, actually, there's. Hang on, what am I talking about? There's the announcement there. So the announcement comes out there. The market's at 130.16. Not much of an impact, and then it's really put a bit on since then. Put about 40 points on since then. But I think if you're going to trade over these sort of announcements, for me anyway, I think it's a bit of a coin flip because you're never quite sure how the market's going to react. You can get quite whippy moves. So I'd never sort of put a trade on 2 minutes before a major announcement like that. But you know, going back to what we've been talking about for the pound for much of this year, you know, the story is one of recovery. That trend for the pound is still definitely up. You know, the bias, I would suggest, would be to be a buyer of any weakness. Let's go back. If we go back to March and pick up our trend line from March, you know, it's clear which way the trend is on the pound. Okay, we've not made much progress over the last week or so, but any dips still look like buying opportunities. And if we flip this over to an hourly, I'll talk more about this when we talk about trends, trend following in a second. You know, these are the sort of moves that we've been seeing. So it's been 9 days-ish, 8 or 9 days since we last had a sort of a major high in the pound based off that trend. But like we've seen back here, when we saw at the end of June, beginning of July, you know, that any sort of sell-offs are corrective at the moment, and the assumption is that we're going to see the market push higher, back above the sort of the 31 level. I suppose the trade would have been, if you were trading in ignorance of the numbers coming out, which is fair enough. The trade would have been when the market had pushed up from July the 20th, so that was what, a week ago. The market had been pushing higher anyway, had gone from 129.40 to 130.80, so a 140-point move. Not that much, I suppose, over a week. The market was sliding off. If I was looking at this in isolation, I probably would have been tempted to be a buyer here at 130.25-ish with a stop loss the other side of these lows, and I'm going to talk a bit more about this in a sec. So 130 whatever and 7. So my stop loss might have been at 129.90. This is the perfect Harry hindsight trade, isn't it? Because I wouldn't, even though the market did break a bit lower, I wouldn't have got stopped out in that. So for me, you know, the same thing holds true now. If we did see the market sell off a bit this afternoon, and this evening, at 7 this evening, we've got the latest interest rate decision from the USA. So we could see some volatility once that's out of the way. That's 7 o'clock tonight. You know, but it looks like any approaches back towards 130 for short-term traders, you know, look to be a buying opportunity, I think, in pound, US dollar. And even if it breaks that, you know, we've got loads of support sort of back at these levels, you know, all the way back down to 129.30. So I think for me, the bias, you know, the easier money, I'd never say easy money, but the easier money is looking to buy dips and try and catch half-decent swings rather than trying to get all these fiddly little short sell-offs before the market snaps back. So let's just have a look at some of the big levels to look out for. For me, it's still the same. You know, the trend for this year has been up. The immediate hurdle is that most recent high at 131.20. Assuming we can crack that, it looks like a move into the post-Brexit vote sort of sidewaysy stuff, you know, up to maybe 134, I think, for the pound. And if it does get up to here, it'll be interesting to see what happens when we get towards 135, and that's still a way away. But but I think the story for this year is still intact. The pound is very much in recovery mode. My bias would be to be a buyer of the dips. Let's have a quick look at the euro. And it's the same story, you know. It's the trend, isn't it? Look at the trend in the euro. Again, this happens every week we do this. Only yesterday it set a new high for this trend. So euro dollar hit just 117 and a bit yesterday. And again, you know, you wouldn't want to, or I wouldn't want to, you know, be trying to pick a top in this just yet. So there's our you know, our trend line in euro dollar. Let's chuck some squiggles on this for those people who like the squiggles. Let's put an RSI on it. There we go. Let's make it a 10-day RSI, because that makes all the difference, obviously. There we go, 10-day RSI. So if you're trading off oscillators, you know, you wouldn't have been buying into this off a daily chart anyway at all this month, because the market has been so overbought. But as we know, when we talk about oscillators, you know, the market can stay overbought or oversold much longer than the RSI or anything else would suggest. You know, it's a market that's still strong. It is interesting up here. You know, if we flip this over to a weekly chart, so euro dollar, all the way through 2015, or through most of 2015, we had what looked like sort of a basing going on for euro dollar, and it did briefly break lower towards the end of last year. But the top of the range ran from sort of 116 up to just above 117. At the moment, the market's trading at just below 116.50. So we're only 50 points below this level. So I think it's a really interesting one to watch. I suppose, you know, if you absolutely had to sell the euro, then now's the time to do it, you know, because it's pushed back up to near what was almost a 2-year high from August 2015. So it's really interesting. It's a really massive level, I think, to watch on euro dollar, sort of just above 117, to see how it performs and see if it can crack. And again, if we can see it trade through 117, it looks like a major breakout. We'll have a look at the Australian dollar in a minute, because we were looking at that last week, because that was a pretty major breakout. So big level to watch there on euro dollar. But again, if we look on the hourlies, we're going to start talking about trends in a minute, but if we look on the hourlies, actually it has such sudden moves, doesn't it? You're either in or you're not in on this last move on July the 20th. I suppose, you know, we have seen short-term support form 116.20 over the last week or so. So I think if you're pretty nimble, there were opportunities there, like early this morning, 9 o'clock this morning, to trade off that level. But again, if we got a deeper pullback from where we are now, there's so much support. You know, down here 114.80, big support down here 113.70, big support again ahead of 113. So I don't think I'd be calling a top just yet in the euro against the dollar, but that big level is an interesting one to watch, just above 117. Okay, let's change tack a bit and talk about trends, and then we'll look at what I think it may be in the short term, at least, more interesting markets to talk about. But let me just do my squiggles. So, you know, if you've ever read anything on trading at all, you will know the age-old phrase, the trend is your friend. So what we're looking to do is trade in the direction of the trend. Markets trend. You know, they don't suddenly decide, okay, there's value. One day they're there, and the next day they're there. You know, they take a while to where they're getting to. You know, so traditionally, if we're looking at an uptrend, then, you know, if you're looking in the textbooks, then the thing gets drawn like that. You know, in the real world, it seldom works as well as that. But then we have our trend line underneath. So the assumption is, you know, any weakness, we don't want to get freaked out and go short. We're looking to buy in to any weakness on the assumption that the trend line is going to hold. And the classic definition of a trend line in an uptrend goes underneath the lows, and we need 2 touches to confirm, or to start drawing the trend line, and the 3rd touch confirms it's a valid trend line. That's the textbook approach. And then, of course, in a downtrend, our trend line looks like that. Okay, so there we go. That's that. So, you know, and I think I think even though I don't personally trade directly off trend lines, I do think it's a good idea for the markets you're watching to plonk them on your charts, because at least it focuses your mind on which way the direction is. You've got that reminder there. So if I've got my chart of what, let's pretend it's oil that we're looking at. If I got my chart like this and I'm tempted to short sell oil, then this trend line reminds me not to be an idiot and go against the trend, you know, because the market knows better than I do. Wait for something else to set up before I sell oil. But what I'll look at, and then traditionally, a break like this, you know, is often described by textbooks as the end of the trend, you know. But that doesn't necessarily have to be the case. And I'm a big fan, and I'll look at some trades I've done over the last week of looking for, you know, previous major lows or highs to give the trend one last chance. So I did a trade this morning on the Bund, and I'll show it in a second. But so for me, the last major low in this example, I would still be watching to see if the market, I'm running out of screen here, if the market carries on the trend, but maybe it's something of a slower pace. But I do think, you know, it's a good discipline, whether you believe in trend lines or not, to put a trend line on the chart, so at least you're focused on which way the direction of that major trend is. And of course you get conflicting trends, you know, you could, because markets don't just move in a straight line. So when we have, you know, if we were looking at this maybe on a 10-minute 2-day chart, we might see this as a downtrend, and that's why we need to step out and look at the bigger picture. So downtrends within major uptrends are opportunities to buy, and then if we're looking at a market like this, uptrends in significant downtrends are an opportunity to sell, you know. And you do, of course, you get these conflicting trends in the market. So there's a bit of the theory. I mean, I think maybe if I go through a couple of things I've done over the last week, it might make more sense. Once again, I have been trading oil, and I have definitely, for now at least, and again I'm going to jinx it, broken my terrible record for trading oil. But before we look at the oil price, I was talking about bonds last week, and I think they're interesting. And let's look. They're not, in my experience, they're not very popular with individual retail investors, but I think they're great markets to trade, you know, because of trends and levels and all that sort of thing. So let me. What we're looking at here, this is the German Bund. So it's a pretty tight spread, 161.85, 161.88. So it's a 3-tick spread. If it's a market you're not familiar with, let's look at, you know, yesterday was a big day. We saw a big move yesterday because it went from 162.55 was the high, down as low as 161.57. So we saw a 100-point move yesterday. But if we take this out, to an hourly chart, you know, we'll see we had look at that trend, fantastic trend. Going back to July the 10th, I think I was talking about this last week because I'd ended up buying here, and I came out yesterday on this big sell-off yesterday. But yeah, the point to make is that the trend line, first of all, would have helped us. So if we're looking in a market like this, if you don't like the idea of bonds, let's pretend it's something else. Let's pretend it's orange juice. The principle is still the same. Yeah. So let's if we were looking at this here somewhere, you know, our trend line looks something like that, and then I'd squiggle it to adjust to that level. So you can see how well this works. And don't forget, this is not, you know, a market that I've had to go back 5 years to find the perfect example. This is a major financial instrument over the last few weeks or so. So the thing to do, if we're in an uptrend, is not be scared of the sell-offs. You know, if the market starts selling off, we're looking for this as a buying opportunity. And for me, I wouldn't set my stop loss the other side of the trend line. What I'm normally looking for is, at the very least, the previous day's low in an uptrend. So I want to have my stop loss below that previous day's low in an uptrend, and in a downtrend, if I'm going short, my stop loss above the previous day's high. But you can see how well this works. So if we have, let's go back. So what I actually bought, I can't remember if it was that day or that day, but the setup was basically the same. Let's pretend I bought there. So July the 13th, the market sells off. So the Bund had been as high as 161.90, drops to 161, so 90-point move, and the market rallies. So that's the low on July the 13th. July the 14th comes back down to it. So 161.18. So if I still believe the trend is up and I want to be a buyer, if I'm a buyer at 161.18, 161.20 in this example, the very tightest I want my stop is below that previous day's low, so the other side of 160.98. And I think I have to say, some of the worst trades I do in terms of not working out are short-term impulsive trades where I basically put the stop loss under today's low. So the market might have sold off for 2 hours, it's gone up for half an hour, and I put a stop loss under today's low. And they don't all get stopped out, obviously, but in terms of reliability and accuracy, it works much better for me if I can just sit on my hands and put my stop loss under yesterday's low. And if yesterday's low is too far away, then that's fine. Just don't do the trades. You know, there will always be an opportunity like this. There's always be an opportunity that gears up somewhere else. So there's the market, pushes higher. And once again, we see this thing playing out. So July the 19th low was 161.57. July the 20th low, 161.56. You know, so yet again, you know, if you were buying into this sell-off, I think it was at the European interest rate decision last week, I think, wasn't it, where the market has sold off. If you were buying into one of these sell-offs and you put your stop loss on the previous day's low, it worked. So basically, I was in, trailed the stop loss, and I got taken out yesterday. But I bought back in today. So I bought back in a couple of hours ago. So I bought at 161. I can't even remember. 75. 161.75. So about 10 ticks lower than where it is now. And the principle for me, you know, it's still the same. So yes, that trend line that's been in place for a couple of weeks has broken, but the market doesn't know it's broken its trend line. You know, so I think we have to apply a bit more logic. So what I've picked up on, again, this really isn't rocket science. You know, is these old lows from back here. We could even go back there, couldn't we? So these lows that have been in place for a week now. So the market yesterday sold off. So we had one day really big sell-off, but we've had 2 or 3 weeks of a market going up. There was a bit of strength this morning, and I'll show you what I did. So that's the big picture view for me. If I was looking at that this morning, the big picture view looks like that, thinking, okay, is the market going to hold above this old low? And then this morning, I had a really short-term chart this morning. Where are we? So it opened up at 7 o'clock this morning. There's the low from yesterday, and there's also that low from about a week ago. The market pushed higher, and I thought, well, this is actually worth a go, and I ended up buying here. I think it was 75, or maybe here, I can't remember, but it looked like, you know, the market was at least having a go at holding above yesterday's lows, and ideally what I need now is a breakthrough these old highs and start clawing back some of that ground. But it all stems from that trend. You know, it all starts from, okay, which way is the trend in this market? So let's see what happens. So I bought at 75. I think my stop is at 45-ish, so my stop's 35 points away. So the market has to move at least 35 points in my favor, so up to about here, for me to move my stop. And if it moves there, I'll move my stop to break even. So I think it's you know, I think one of the problems people have is placing stop losses too tight, and I'm guilty of that as well. So I think if you can place it past at least a level from a day ago, then it's a sensible, logical thing to do, and I think it can help filter out a lot of impulsive too short-term trades. So let's see what happens with that one. It's so bun. I think they're interesting buns because I think, so again, for me, the trend is still up. Maybe, ideally, it pushes back up to where it was yesterday, so it's another 80 points from where we are now. Let's see what happens. There's this Fed meeting tonight, which could put a spanner in the works, but might lift the market as well. So let's see. So that's one way of using trends. So I think if you're looking to, I didn't do it on this trade, but I think if you're looking for like major trend reversals, like back here actually, which was a trade I did a while back, sticking with the same market. If you're looking for major trend reversals, let's say we've got a market that's been sliding, I think at the very least, you have to wait for it to stop making lows. You know, if you think, well, okay, this market's going to turn around, well, it makes a low for the day there, it makes another low for the day there. You know, if you're buying in, you're buying in too early, which I also do as well. Yeah, we want to at least look for the market to shake off and stop making new lows, at least have one day where it doesn't break to new lows, and then maybe you get in on a pullback, or maybe you just buy straight away with a stop the other side. So again, I think that's another way, maybe a little tip if you're looking to get into trends. The same with shorting. You know, we talked about the euro. Let's just flip back to the euro chart. Let's go back to our euro daily. So on the euro daily chart, at least if you really want to go short the euro, at least wait for it to stop going up. You know, a simple thing to say, but pretty logical. You know, it was only yesterday we saw the euro at what, a 2-year high. So the euro's at a 2-year high yesterday. You want to go short? What are the chances? What are the chances that when it's making 2-year highs that you nail the top? You know, it's highly unlikely, isn't it? So we at least want to wait for it to run out of stream. Maybe the bigger picture approach here. If we flip this over to a weekly candle, if you really want to go short the euro ahead of this big level, at least wait for a week where it doesn't make a new high for the trend. You know, so that's a real sitting on your hands strategy. But because it is a major level, if it is going to be a major level and the market's going to dump from here, you think it's going to take a while to turn around. You know, let's see what happens. But I think that to wait for the market to stop moving with that trend, if you're trying to trade counter trend. Let's have a quick look at stock markets. Then we'll take a look at oil and gold, and the Australian dollar we've got to look at as well. But let's take a quick look at stock markets. Someone's just asked the question, do you believe in Elliott Wave? I don't. I think it, how can I be polite about Elliott Wave? I think for me, you know, I'm not a big fan of Fibonacci. I've talked about Fibonacci in the past, and clearly Fibonacci is wrapped up in Elliott Wave as well. I have a real problem with you know, trying to impose you know, definite absolute rules on how a market should move. You know, an Elliott Wave, the market, you know, an uptrend from memory, you know, goes up in waves of 5. So the 1, 2, 3, 4, 5 wave. Then you have an ABC correction. So it goes up in 5 and corrects in 3. And I used to read a lot of Elliott Wave analysis in the early 2000s, and they used to always be revising it. It used to be like, all right, we're now in the wave 3 extension, so the market should go down. Then a week later, the market would be up and say, oh, actually, no, we're not in wave 3. We're in the C correction of the second wave. And it's just so much of that stuff that I just think is a bit too mystical. So I'm not a fan at all of Elliott Wave. I wouldn't waste your time with it. That's my opinion. Here's the S&P 500. And again, on this, I did a couple of trades yesterday, and they both made money, but they didn't move to where my target was going to be. But again, it's going back to this this idea of previous days' highs and lows. Let me just zoom in. US stock markets hit all-time highs again yesterday. You know, so again, I don't think the Dow did, but the Nasdaq and the S&P certainly did. So again, there are trends that you don't want to bet against. You know, the strategy for trading the US stock market, the buyer should be looking to be a buyer. You know, looking to be a buyer on dips. So we'd had a bit of a sideways market. This is July the 21st. The lows on the S&P at 24.65, and then look what happens. You know, we had hits it again on the 24th, hits it again a bit later in the day, and then if we go to a really short-term chart, there's been a big level this week on the S&P, or is that the same level? Yeah, it's the same level. What am I talking about? It's the same. So what is the date today? It's the 26th, isn't it? 26 today. 26. So the market, actually, it just broke higher, didn't it? But I'd say the levels to watch this afternoon, you know, the market broke out to fresh all-time highs yesterday, the S&P 500. Then it sold off back to about 24.74. Then it moved higher. Overnight, it's come down in the early hours this morning back to 24.74. So clearly, I think for short-term traders, any weakness back towards 24.74, yesterday's low, looks like potentially a buying opportunity. Any rallies back up to yesterday's high, ahead of 24.81, look like a selling opportunity. It's a really tight range, and that's 7 S&P points. It's not much. That's not very much at all. But I think those are the levels to watch. But I think we could have a quiet afternoon ahead of this interest rate decision from the US. But just to remind ourselves of the big picture, you know, this is the trend. You know, that is the trend for the S&P 500 and for many of these US stock markets at the moment. And I'm sure, you know, you can get with some brokers, you can see sentiment, you can see which way people are trading. You know, most retail clients, more than 50%, are short. You know, why are they short? Because the market's going up. If the market was plunging, they'd be long. You know, people can't trade with the trends. Most of us cannot have a problem trading with the trends. You know, so with the S&P, you know, there's our trend line, or one trend line on the S&P. You know, even if the market fell 80 big points from here, so you know, the equivalent of 800 Dow points, that market is still in an uptrend from those sort of the US election last year. You know, a move back to 2400, 2410 on the S&P looks like a great buying opportunity. you know. But let's see what happens. We're jumping around a bit, but what we're going to do now. Let's have a quick look at the Australian dollar, because we picked it up as a breakout last week. Then we'll have a look at gold and oil. And I think oil is really interesting. We'll look at gold first, then we'll talk about oil. But first of all, let's just do the Aussie dollar, US dollar. So going back, let's have a look at a weekly chart first of all. So it's a bit unresolved, this, to be honest. But we had the downtrend. Actually, I suppose it's quite appropriate talking about trends. So we had a downtrend for a while in the Australian dollar against the US dollar. Then last year, it looked like it was starting to break out of it, but it could never really make that much progress through sort of 77.50, 7800 until last week. And last week we saw the Aussie dollar hit its best levels for a couple of years. So, you know, a bit like where the euro is now. So there's a whole story of dollar weakness going on. So it's broken out. If we flip this over to a daily, I think this is why I think breakouts are breakouts are, I think, quite hard to trade, because the market has broken out through those old highs. But look what it's done over the last week. It's done nothing at all. You know, we've gone really sideways. So I don't know what the answer is here. You know, I think we still need maybe a bit of time. If you were convinced of the breakout, I think this market is going to just go soaring away in the months to come. You could be a buyer at 79.20 now, and you place your stop loss, I don't know, perhaps the other side of the breakout at 77.20. So you give it a 200-point stop loss, which again sounds like a lot, but I don't think it is. If you think the market is going all the way back up to here, that's a couple of thousand points, you know. So a 200-point stop loss sounds pretty reasonable. But I think based on, you know, what the price has been doing, nothing has happened over the last week, but the breakout remains valid. You know, it's pushed out to its best levels for a couple of years, but I think it's still a really interesting one to watch. And I'd still be inclined, I think what we really need is a sell-off, and then see if it holds in the old breakout zone, and then be a buyer then. But it's a bit inconclusive before then. So someone's asking, how would you approach a 3-minute time frame? I wouldn't. Is a quick answer to that. I wouldn't approach a 3-minute time frame. But I mean, you can if you want. I mean, the principles are the same. You know, let's look at the DAX. Let's look at the we can't do 3 minutes in this. Do a 2-minute DAX chart. Okay. So how would we approach this? Again, it's all a bit Harry hindsight trading, isn't it? But let's look at what the market has done today. So the DAX this morning, the low has been 12,250. And we've traded as high as nearly 12,350. So we've had a 100-point range on the DAX. The market has been building up support here. So the market's been building support this morning. So from about 8:15, 12,280, and then here 12,290. So there's been a lot of support from 12,280 to 12,290. So what we really need here is a time machine to take us back about 5 minutes so we can buy in this area here, because clearly that had been a level of support. It's broken through, but it's held. So I would say if you're looking at a really short-term chart like this, the opportunity here, if the market pull back to 12,300-ish and a stop loss 25, 30 points away down here. But I do think a mistake again that many people make is they look at two short-term charts. You know, if you're looking at, you know, I'm not saying you can't make money trading off 2-minute charts, 1-minute charts, 5-minute charts. I'm just saying most people can't, in my experience. You know, I think people end up being far too short term, getting whipped out, and just really getting ground down by it. But I think in essence, I wouldn't approach it any different to a longer term chart. But I think for most of us who don't want to sit or can't sit in front of a screen 12 hours a day, the higher time frames are maybe better. Right, what was we going to talk about? Gold. So we'll talk about gold. This has been, let's flip this off. You know, I think for me, at the pound this year, I think what gold is doing is still sort of in recovery mode. Again, if we go back to the principle of trends, which would look, you know, something like that. We've had trend lines break. Look all the way they've broken. With a trend there that'd been in place for a couple of months, that broke, but the market didn't take out the previous big low. Then we had this new trend line that formed that was in place for 4 months. Again, that broke, but the market didn't take out this previous low. It's all got a little bit messier since then. We've had this, so again, there's our trends. It has broken that old low, but for me, the big lows for gold are still 1180 to 1195, 1200. So I still think for now, as long as these levels hold, the trend for gold is still just about up for this year. So I don't think, I maybe wouldn't want to be a buyer here. We'll look at a shorter term chart in a minute, but if it pulls back again to sort of 12.15, it looks like a buying opportunity. Let's flip onto an hourly. We'll look at oil in a minute, which I think is maybe a bit more interesting. So on an hourly chart, there we go. If you were trading it on an hourly chart, so we're going back here to July the 10th. So this is what the last couple of weeks of trend. So our trend for the last couple of weeks looks something like that. There we go. So you could argue, I think it's a reasonable argument, if you're a buyer now of gold at 1247, you'd have a stop loss based on the trend and everything else. I'd have it the other side of this level, 1235. You know, so we had this level. The lows held July the 18th, July the 19th, and July the 20th. There we go. So 1235, in the short term at least, over the last week, has turned out to be a big level for gold. So arguably, either today or tomorrow, there's an argument off the hourly chart to be a buyer looking for the market to go higher. So someone said, I only have a small account. I think that's fair enough. That most people only have small accounts. I think, and that's why I think it's maybe better to trade the longer term. I mean, an hourly chart is hardly long term, isn't it? But I do think a common mistake that people think trading is all about sitting in front of the screen, click, 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 buy, sell, buy, sell, buy, sell, and it's not. You know, I do maybe one trade a day. I think. I don't think you need to be sitting there jumping in and out. And I think if you've got a relatively small account, you're just going to churn it up with short-term trades like that. And I think it's having the discipline to wait for the better setups to come along. So there's gold. I think it's still bullish. I think in the short term, I'm assuming that 1235 could hold, and we'll have another run up. Maybe that's the run that has a look at 13 again, 1300 again. But the bigger picture view, I think 1180 to 1200 is still the big level of support. Right, let's have a look at oil to wrap things up. Oil is interesting because this afternoon at 3:30, every Wednesday, we get the oil inventory figures. So how much of the US has got stockpiled, I think. So we often see lots of volatility off the price of oil. But once again, look at this. You know, how the big levels have held on oil. We had, okay, it did sort of punch through back here, but we had the lows from September at about $43 a barrel, $43 a barrel again in November, 44 it touched in May before ramping up to 52. And this week, okay, this month or last month, sorry, it has punched through. It traded as low as 42.27, but again, we've seen quite a strong reversal off that level, and we do have, if we just zoom it in, so I am currently long oil, but if we zoom it in, and I'll just go through again just the reasons for the trade, and it's not rocket science. So there's, at the moment, that's our little trend for the last month in the price of oil. So it's been chugging higher. We've got a little lap trend in place. Let's flip it out to the hourlies. So the trade I'm currently in, which was too early, but again, the rationale behind it was this. So we have our recovery trend. That's what the market was doing. So I traded it bits and pieces on the way up. And again, it comes back to these levels. I think the first thing to think about is where's your stop going to go? So let's just look what happened. Let's walk through this. July the 11th, the market runs higher. So breaks through these old highs. So it does suggest there's a bit of momentum here. So that's trading around about 45. Then it pushes up to 46.5, sells off to 45-ish, goes up, comes back, but again 45 holds. So again, if you want to be an aggressive trade here, to be a buyer in here somewhere with a stop the other side of those lows, the market pushes up. July the 14th, trades as low as 45.97, pushes up to 47, comes back, and where does it hold? Once again, these old lows from back here have held. And then I bought down here. So I bought bits on the way up and sold bits on the way up. And I bought, and you can see actually I was too early. There was no reason to think I should be a buyer based off the hourly chart. But what I was looking at were these old levels back here. And I think these are still valid levels over the next week. So I was looking at, so I bought the trade I'm currently in, I bought at 46 and 1 cent. So I bought here because I think on a 10-minute chart it held above those old lows, but I placed my stop beyond what I thought was a bigger low, a bigger level. So back here, so my stop was at, so I bought at 46, my stop was about 44.80, I think, so down here. So I was buying in here off this line, but putting my stop below, what I thought was a major low back then. The market did slip a lower, went about 50 cents against me, but it came back to the trend line, and this was the better trade because it came back to the trend line here. So if I'd been a bit more patient, I had hours to get in at a much better level and still have my stop beyond there. And then since then, yesterday, the market just rocketed. So there's our trend in oil. So we often get quite a lot of volatility off these inventory numbers this afternoon at 3:30. So again, it looks, if we did see, a sharp sell-off back towards the low 46, it's basically the same trade again. So I think it's interesting, the trending oil, this recovery trend that we've got going on in oil, flipping us back to the daily. So at the moment, the expectation might be for it to squeeze a bit higher. I suppose you could argue that we do have, a bit of a downtrend going on, like from here. So it'll be interesting to see how that all plays out. So let's see what happens around the 49 level. But it looks like any weakness back to 46, you can see it clearer on a daily chart. We could well be looking to be a buyer, but we could see quite a bit of volatility off the back of that. So really, to summarize, I think that the thing to watch this afternoon is oil, because the oil inventories are out at 3:30. I think it's going to be a quiet afternoon because we've got the Federal Reserve thingamajig tonight at 7 o'clock tonight. Everything else is pretty much as it was a week ago. The euro is still incredibly strong against the US dollar. Stock markets are still incredibly strong. We should be looking to buy dips, and pound against the dollar is still strong as well. So I think not much has changed over the last week or so, although there have been opportunities to trade, I think, based on looking at things like trends. And hopefully today has demonstrated, we've looked at dailies and hourly charts mainly. You don't have to be really short term. You don't have to make a decision normally in a nanosecond. The trends take a while to develop and a while to turn around, and I think it's just spotting them and maybe following these markets can give you opportunities to get in. And I've shown you some of the trades I've done. I'm always normally far too early. Just get in too early, and I should have a bit more patient, like with this oil trade. If I'd have waited for it to go back to the trend line, it'd have given me a much better entry. I would have got in at least 50 cents, or maybe 50 cents lower than I ended up getting in, an extra 50 points in the trade, tighter stop loss, could have started moving my stop loss sooner, all that sort of stuff. So I think if we have a bit of patience, it can pay off. So I think the thing to take away from today, hopefully, chuck trend lines on your charts. Don't get too het up in the sort of the 2-minute, 5-minute charts, and look for obvious places, to place stop losses and all that sort of stuff before you put the trade on. But we'll wrap things up there. As usual, if you have any questions, you can follow me on Twitter. My Twitter thingy, I haven't tweeted much the last couple of weeks, I'll pull my finger out, is @JonesTheMarkets. If you have any questions afterwards, drop me an email, david@tradeafter.com. And also, I've been blogging about a real account with £2,000 in, trading with AUDUSD copy trade. That's been going since February. So if you go to the website, tradeafter.com, you can see that. But let's see, I think it's going to be a quiet day today, and then hopefully back to normal once this Fed decision's out of the way. Thanks for coming along as usual. We'll do it all again next week, same time next week, Wednesday lunchtime. And as I say, any questions, feel free to drop me an email. Thanks. Bye-bye.